Tonight is not a night for sleeping. It's Friday. The trading floors are dark. The algorithms are off. And right now, in some sealed conference room, dozens of floors above street level, a group of people in expensive suits are staring at a spreadsheet with your account number on it. They are making decisions this weekend that will determine whether what you think you own is actually going to be there when you log in Monday morning. What I'm about to walk you through is the exact sequence of events that preceded every major wealth destruction moment in modern financial history. The conditions tonight are more aligned with that sequence than at any point since 2008, arguably worse. And by the time I finish laying out the numbers, you'll either agree with me or think I've lost my mind. Either way, you're going to hear this before you close your eyes. Let's start with the crime scene. Silver closed today near $68.71 an ounce. That sounds fine. Except 6 weeks ago, on January 29th, silver hit $121.67 per troy ounce, the highest nominal silver price ever recorded in all of human civilization. Higher than the Hunt brothers in 1980, higher than the 2011 spike, higher than anything anyone alive has ever seen. And now, barely 2 months later, it's sitting at $68. That is a 43% collapse from an all-time record high in 60 days. Think about what that kind of move does to the banks that were short on the way up. The billions wiped off those balance sheets, covering naked short positions, are not theoretical. They are real, and they are exactly why tonight feels the way it does. Gold is telling the same story. At $4,433 an ounce this afternoon, it's sitting 21% below the $55.95 high it also hit in January. The financial media will call this a healthy correction. What they won't tell you is that these drawdowns are manufactured, the direct result of CME margin hikes, coordinated short selling, and a deliberate campaign to flush retail investors out before the next move. And that next move may be triggered this weekend. Standard disclaimer: this is not financial advice. It's a survival briefing. Do your own research, but notice that the same institutions telling you to trust the system told you inflation was transitory in 2021, that the banking system was solid in 2023, and that Bear Stearns was fine on a Friday before it collapsed by Sunday. These are the same people who watched Lehman burn on a Sunday night and waited until Monday morning to tell you. And I need you to absorb one pattern before we go any further. Bear Stearns, a weekend. Lehman Brothers, a weekend. Washington Mutual, seized on a Friday evening. Silicon Valley Bank, announcement to seizure in a single Friday. Signature Bank, Cyprus, all weekends. Every account freeze, every rule change, every moment where ordinary people woke up to a different financial reality happened during that 48-hour blackout window when markets are closed, cameras are off, and there is no mechanism for you to move your money. That is not coincidence. That is the playbook. And tonight, it's being loaded. Let me give you the data the mainstream press isn't showing you. COMEX registered silver is the single most important number in the precious metals market, and almost nobody covers it. Registered silver is the physical metal sitting in exchange-approved vaults that is actually available for delivery against futures contracts. The real bars, the actual metal backing the paper promises. As of late February 2026, COMEX registered silver dropped below 90 million ounces. Context: in October 2025, total COMEX silver inventory was 532 million ounces. Today, it's approximately 366 million. That's a 31% decline in total inventory in 5 months. The registered portion, the only part that can actually be delivered, fell to 88.19 million ounces, a 32% decline in deliverable supply in 4 months. Now let me do the math live. Open interest on silver futures sits at roughly 230 million ounces. Those are paper claims. Divide by the 88 million ounces of registered silver actually available for delivery, and you get a paper-to-physical ratio of 2.61 to 1. That's the conservative number. When you factor in the full open interest across all contract months, including the April contract that hits first notice day in 2 business days, that leverage ratio climbs to 7.4 times. 7.4 ounces of paper claims for every single ounce of real, deliverable metal. That number should stop you cold. Hit the like button right now. The algorithm actively suppresses content like this. Every time I run COMEX inventory numbers and paper-to-physical ratios, my reach gets cut in half. The like button is the only weapon we have against that suppression. If this video has given you one data point you didn't see on Bloomberg today, use it, because it's the only way this reaches people who need it before Monday morning. The coverage ratio on COMEX, measuring what percentage of outstanding paper claims could be satisfied with registered physical inventory, is sitting at 13.5%. Anything below 15% is considered stress territory. This has only happened a handful of times in the entire history of the exchange, and every single time it did, it was followed by a delivery crisis, a forced rule change, or an emergency cash settlement event. Every time. And we are 2 business days from first notice day on the April 2026 silver contract. Right now, 1,981 contracts remain open. At 5,000 ounces per contract, that's 9.9 million ounces of physical silver that holders can begin demanding delivery of starting Monday. That sounds manageable until you realize that in just the last 30 days, COMEX registered inventory declined by 10 million ounces. 10 million ounces walked out of those vaults in a single month. To London, Shanghai, private storage, anywhere outside the paper market's control. I've spent hundreds of hours digging into bail-in legislation and clearinghouse default procedures, so you don't walk into this weekend blind. If this research has real value to you, consider hitting super thanks below. It keeps the lights on, while the financial media tells you the opposite of what the data shows. Now let me explain the mechanism, the part nobody discusses with enough clarity. You need to understand the difference between a bailout and a bail-in, because it is literally the line between keeping your wealth and watching it disappear legally. A bailout is 2008. Banks blew up. The government stepped in with public money. TARP was $700 billion. Total Federal Reserve emergency lending across all facilities ran somewhere between $500 billion and $29 trillion, depending on who's counting. The public absorbed the cost. That was a bailout. A bail-in is the reverse. This is what Dodd-Frank created. Title II of the Dodd-Frank Wall Street Reform and Consumer Protection Act, signed July 21, 2010, established the Orderly Liquidation Authority, the OLA. The OLA grants the FDIC the power to take over any financial company that the Secretary of the Treasury, in consultation with the Fed Chairman, determines poses a systemic risk if it fails. Once in control, the FDIC has legal authority to convert that institution's debt into equity. That means your deposits, your account balances, your unallocated silver can be legally transformed into shares of a failing bank. You walk in with $100,000 in silver exposure. You walk out holding stock certificates in a bankrupt institution worth cents on the dollar. And here's the piece that should keep you up. Under Dodd-Frank, derivatives, the bets banks make against each other, receive legal priority over the claims of unsecured creditors. Do you know who qualifies as an unsecured creditor? You do. If you hold silver in an unallocated account, you did not purchase a specific bar. You did not take possession of a serial numbered piece of metal. Legally, you extended an unsecured loan to a financial institution. When that institution fails, the derivatives counterparties get paid first. The hedge funds with their credit default swaps get paid first. You, the retail account holder, stand at the back of a very long line. The scale of this matters. The top 25 U.S. banks hold over $206 trillion in derivatives exposure. The entire GDP of the United States is roughly 28 trillion. The FDIC's Deposit Insurance Fund holds approximately 130 billion. Do that math. 130 billion divided by 206 trillion equals 0.063%. The insurance backstop covers less than 0.1% of derivatives exposure. If even 2 or 3% of that book goes bad, the FDIC cannot cover it, not remotely, and, when they run out of resources, Dodd-Frank gives them the legal authority to bail in and take your money. Now let me walk you through 3 historical precedents, because I don't make claims without showing you this exact pattern playing out before. Cyprus, March 2013. On Friday, March 15th, Cypriot banks were open and functioning normally. Zero warning. Over the weekend of March 16th and 17th, Eurogroup ministers agreed to a €10 billion bailout contingent on depositor losses. Banks stayed shut through March 19th. For nearly 2 weeks, ATMs were drained, wire transfers frozen. When it was over, uninsured depositors at Bank of Cyprus had lost 47.5% of everything above €100,000, converted into equity in a broken institution. No vote, no appeal, a weekend. Silicon Valley Bank, March 2023. On Thursday, March 9th, SVB disclosed a $1.8 billion loss on a $21 billion security sale. By Friday, March 10th, the FDIC seized it. Over the weekend, the Fed, FDIC, and Treasury held emergency sessions. Sunday night, a systemic risk exception guaranteeing all deposits. But here's what the headlines buried. That exception was a political decision, not a legal guarantee. Without it, 94% of SVB's deposits were uninsured and would have entered the standard FDIC resolution process, which delivers pennies on the dollar to unsecured creditors and can take years. The entire crisis unfolded Friday to Sunday. Monday morning, different rules. Lehman Brothers, September 2008. Friday, September 12th, frantic negotiations at the New York Fed to find a buyer. The weekend passed with no deal. Monday, September 15th, Lehman filed for the largest bankruptcy in U.S. history. $700 billion in assets, 25,000 jobs. Within 48 hours, global credit markets froze, the commercial paper market collapsed, money market funds broke the buck. All of it because a decision made Sunday night became Monday morning's catastrophe. 3 weekends, 3 moments that erased the wealth of people who went to sleep Friday night thinking they were fine. And tonight, conditions are worse than any of those 3. Because this time, it's not just about bank deposits. It's about the gap between paper precious metals claims and the physical reality beneath them. And that gap has never been wider. Let me know in the comments right now, do you hold physical silver in your possession tonight? Or are you trusting a financial institution with a paper promise? Tell me what premiums look like at your dealer. The ground truth is the only truth that matters. The bar in your hand cannot be frozen, suspended, or rewritten. Here's what Monday could look like if this plays out. A major clearing member notifies the CME it cannot meet delivery obligations. This happens over the weekend because that's when the administrative machinery runs. The clearinghouse activates default procedures, liquidating positions, seizing collateral, tapping the guarantee fund. If the guarantee fund is insufficient, the clearinghouse declares force majeure, the legal term for we cannot deliver what we promised. In the precious metals market, force majeure means one thing: cash settlement. The exchange pays you a cash amount it determines to be fair, not the physical market price, not what you'd receive selling real metal. A price set by the institution that just defaulted on its delivery obligation, and it will be at a discount because physical silver is already trading at a premium to paper. The Shanghai Gold Exchange has been pricing silver at $10 or more per ounce above Western spot. That's not an arbitrage glitch. That's a 2-tiered market where the physical world prices metal at what it actually costs to source, while the paper market prints whatever number keeps the most stressed institutions alive for one more day. Monday morning, you open your brokerage, check your silver ETF, and see either grayed out buy and sell buttons because the fund has suspended redemptions, or your account balance has been converted from ounces of silver into a dollar figure well below where physical silver is actually trading. Your claim to metal replaced with a number in depreciating dollars. Nothing to appeal, because page 47 of the prospectus you never read says the fund reserves the right to cash settle in lieu of physical delivery under extraordinary market conditions. This is not hypothetical. Nixon did exactly this in 1971 when he closed the gold window. The LME did it in nickel in 2022 when it retroactively canceled billions in trades and imposed a price it found acceptable. The paper market was overridden by the people who run it. The Mathing Silver says this happens again. 88 million registered ounces, 230 million in paper claims, 13.5% coverage. Let's talk about the repo market, because this is the mechanism connecting a silver delivery crisis to the entire banking system. The repurchase agreement market is where banks borrow short-term cash by pledging collateral, treasuries, corporate bonds, sometimes precious metals warehouse receipts. It processes $4 to $5 trillion per day. When a bank faces a silver delivery shortfall, it needs to raise cash fast. It goes to the repo market and pledges assets as collateral. But its counterparties know that bank is sitting on massive unrealized losses from silver short positions. They demand higher haircuts, the gap between the collateral's market value and the cash they'll advance against it. Normal haircuts, 2 to 5%. Under stress, 20, 30, 40% or more. When haircuts spike, the bank must pledge far more collateral for the same cash. If it doesn't have the collateral, it can't roll overnight funding. When overnight funding evaporates, you get a liquidity cascade. Forced selling, margin calls, counterparty defaults spreading institution to institution. That is Bear Stearns. That is Lehman. They didn't die because they were technically bankrupt. They died because no one would lend them money for one more day, and the repo market made that call overnight, in the dark, over a weekend. This is the complete chain. Silver market makers bled billions on today's expiration. COMEX inventory declining 10 million ounces per month. Coverage ratio at 13.5%. 9.9 million ounces standing for delivery Monday. Banks going to the repo market tonight to cover. If counterparties tighten their haircuts because they know the silver shorts are bleeding, those banks can't fund themselves. And when they can't fund themselves, they reach for Dodd-Frank, the bail-in provisions, the clause that classifies you as an unsecured general creditor and makes taking your silver perfectly legal. I'll be monitoring clearinghouse liquidity reports and Federal Reserve emergency facility data all weekend. If something breaks, you hear it here before CNBC or Bloomberg decides you're ready to know. Subscribe with the bell on right now. Now the geopolitical dimension, because this is a global monetary realignment, not an American market problem. BRICS nations, Brazil, Russia, India, China, South Africa, and the growing membership list have been accumulating physical gold at an unprecedented pace. China's central bank made official gold purchases for 15 consecutive months as of January 2026. Not ETFs, not futures, physical bars shipped to sovereign vaults in Beijing. Russia has been stacking since Western sanctions hit in 2014. India expanding gold imports quarter after quarter. These governments know what I'm telling you tonight. A paper claim is a liability in a crisis. Only physical possession counts. The Shanghai premium of $10 or more above Western spot is not an anomaly. It's the physical market openly declaring what real metal actually costs when you have to source it, not print it. This is the London gold pool of 1968 all over again. European central banks tried to suppress gold by selling physical metal. They ran out. The pool collapsed, and 3 years later, Nixon shut the gold window because nothing was left to deliver. We are watching the same dynamic in silver right now. The Bank for International Settlements has upgraded gold from a Tier 3 to a Tier 1 asset under the Basel framework, officially treating physical gold the same as cash or government bonds for capital reserve calculations. Gold has been remonetized by the very institution that oversees global banking. Silver faces the same trajectory, driven by a structural industrial demand deficit. Solar panels, AI data centers, defense technology, electric vehicles that has persisted for 6 consecutive years. 6 years where combined industrial and investment demand exceeded total mining output plus recycling. And that deficit does not shrink when prices fall. It gets worse, because miners can't operate at a loss, and recycling volumes drop with price. So here is the complete picture in one place. A physical metal in a structural multi-year supply deficit. COMEX inventories draining at an accelerating rate. Paper to physical leverage at 7.4 times. Coverage ratio in stress territory at 13.5%. April 1st notice day in 2 business days. Banks sitting on billions in unrealized losses. Bail-in legislation giving those banks legal authority to convert your unallocated accounts into equity. A 48-hour blackout window with no price discovery. And 3 documented historical precedents confirming that every major banking confiscation event in modern history happened during exactly that window. All of it converging tonight. Follow the secondary channel in the featured section below. This channel handles the macro framework. The secondary goes deep into trade setups, physical dealer reports, vault audits, and on-the-ground intelligence that doesn't fit a single format. You need both. Here's what you actually do. You remove your wealth from the system. You take delivery. If you hold silver in an unallocated account, call your institution tonight if they have a 24-hour line or first thing Monday, and demand conversion to an allocated account or direct physical delivery. Allocated means specific bars with specific serial numbers legally assigned to you in segregated storage. Bars that cannot be rehypothecated, lent out, or used to cover the bank's own delivery obligations. In an unallocated account, the bank can do all of those things. You have no claim to any specific bar. You are a line item. In a bail-in, that line item disappears. Most institutions will respond with higher fees, delays, or outright denial. That is by design. Every ounce that leaves their vault is an ounce they can no longer leverage. They need your metal exactly where it is. But the only complete immunity to a weekend bail-in is physical possession. Your metal, in your home, under your control. No custodian, no clearinghouse, no counterparty, no algorithm, no clause buried on page 47. If you don't hold it, you don't own it. That principle has survived every currency crisis and every empire that debased its currency from Rome to the present day. The only new development is that a very sophisticated and very profitable illusion was built to convince you a piece of paper that says silver is the same as silver. It is not. It has never been. And this weekend, that illusion may shatter for millions of people who didn't hear this warning. If you want to see exactly how I've structured my own holdings to be insulated from weekend bail-ins and clearinghouse defaults, the specific breakdown between physical metal, allocated storage, and hard assets, hit the subscribe button and come inside. Insider members get real-time portfolio updates, vault allocation frameworks, and emergency weekend alerts the moment clearinghouse data starts flashing. The cost of missing what comes next could be your entire unallocated position. It is Friday night. The markets are closed. The banks are in those rooms. The COMEX vaults are running on fumes. The bail-in statutes are loaded. And 99% of retail investors are going to sleep tonight thinking everything is fine. Don't be one of them. Check your accounts. Know whether you hold allocated or unallocated. Know whether you own the metal or whether the metal is someone else's collateral with your name attached to it.